You've spent hours analyzing the charts. You've mapped out the exact support and resistance levels, spotted a flawless head and shoulders pattern, and precisely calculated your risk-to-reward ratio. On paper, it is the perfect technical setup. Then a single inflation report drops. In a fraction of a second, a massive price spike rips straight through your stop loss, completely invalidating all that careful geometry. For a technical trader, these external factors are a constant threat. Central bank speeches, geopolitical tensions, and surprise economic data points act as invisible landmines, completely disconnected from the actual lines on your chart. The reality is that traditional financial markets will always prioritize macroeconomic events over chart geometry. If you're trying to trade pure price action, you are operating in an environment built to disrupt it. Imagine if you could isolate your trading strategy. A pristine laboratory where every unpredictable real-world variable, every news alert, every sudden rate hike has been permanently stripped away. This is the exact environment provided by synthetic indices. They are simulated, continuous markets that run 24 hours a day, 7 days a week, immune to global holidays and time zones, where price movement is the only variable that exists. Here, your technical skills are tested strictly against mathematical algorithms. It offers a true fundamental free sanctuary, completely clear of the external noise that causes sudden weekend gaps or news-driven liquidations. Of course, the moment you hear simulated market, the immediate assumption is that the broker controls the algorithm, drawing squiggly lines just to hunt down your retail stop losses. But these markets are actually powered by a cryptographically secure random number generator, or RNG. This engine produces a continuous, unalterable output line that strictly dictates the price. This RNG is specifically coded to replicate real-world market behaviors. You'll see established trends, predictable volatility, and mean reversion, all functioning purely on math rather than the erratic flow of human buy and sell orders. To ensure fairness, these algorithms are strictly audited by independent third-party firms. The broker is entirely blind to your individual stop losses. They cannot access or manipulate the data stream to trigger a specific price level. Ultimately, trading against a mathematically mandated, openly audited algorithm offers a much more transparent and level playing field than trading against traditional forex brokers, who might artificially widen spreads during a volatile news event. Because this environment is entirely controlled, it is divided into distinct mathematical climates. Different asset classes are programmed with specific behaviors to match different risk tolerances and trading styles. This visualization shows two volatility indices. On the left is the V10, programmed with low, steady movement for slow trenders. On the right, the V75 is highly erratic, moving thousands of points in minutes, making it a favorite for aggressive scalping. Then there are the crash and boom indices. Their programmed logic creates a very slow, predictable drift in one direction, abruptly interrupted by sudden, massive algorithmic spikes in the opposite direction. For traders who want extreme precision, step indices replace fluid ticks with rigid block movements. The price moves strictly in fixed mathematical increments of 0.1, creating a literal digital ladder. Success in this environment entirely depends on your ability to accurately match your personal risk tolerance and psychological makeup with the specific mathematical pulse of your chosen asset. But there is a massive catch. If you bring traditional forex lot sizing into a synthetic market, you will quickly liquidate your account. Risk management here is a completely different discipline. Forex microlots are 0.01. But the volatile V75 minimum is 0.001. Mistakenly using a 0.10 lot turns an algorithmic swing into a massive loss. Always calculate point value first, multiplying a 10,000-point move by the minimum lot size to reveal your total dollar risk. Because there are no unpredictable news gaps to blame for your losses, mathematical ignorance regarding lot sizes is the single greatest threat to your trading capital. Once your risk is calibrated, you finally get to test pure strategy. Because the algorithm strictly obeys mathematical momentum rather than fundamental fakeouts, traditional geometric chart patterns play out with remarkable consistency. Applying the zone method to the erratic V75 index, drawing a single thin trend line is useless. Instead, draw thick rectangular resistance zones. The price violently wicks into these zones, hits algorithmic resistance, forms a clean rejection candle, and perfectly reverses. Momentum oscillators are equally effective in this environment. On a slower index like the V100, checking the Relative Strength Index, or RSI, clearly signals when the algorithm is overextended. If price pushes higher, but the RSI drops, that divergence reliably indicates an imminent mean reversion, with zero risk of news interference. Transitioning to synthetic indices shifts the focus from geopolitical news to technical execution. It doesn't magically make the markets easy to beat, but by stripping away the unpredictable global news cycle, it creates an environment where strategy and risk management are the only factors determining the outcome. It's time to see what your pure price action skills can actually do. Open a demo account, calculate your first point value, and test your technical strategies in a market that never sleeps, never lies, and completely ignores the news.